The current state of the Arab Oil Embargo 1973 Strategic Power, Economic Shock, and Systematic Transformation. Introduction Energy as an Instrument of Strategic Coercion. The Arab Oil Embargo of 1973 represents one of the most consequential demonstrations of economic weaponization in modern geopolitical history. It transformed oil from a mere industrial commodity into an instrument of strategic leverage capable of reshaping alliances, destabilizing macroeconomic structure, and forcing structural adjustments across global political economy. The embargo was not simply a supply disruption, it was an assertion of resource sovereignty by oil producing nations seeking to rebalance power asymmetries embedding within the post World War II economic order. The declassified intelligence assessment titled The Current State of the Oil Embargo, dated 5th of November 1973, provides a contemporaneous evaluation of supply reductions, geopolitical responses, and projected consumption deficits across major industrial economies. The document reveals that oil producers pursued coordinated production cuts of approximately 25%, targeting nations perceived as strategically aligned with Israel during the Yom Kippur War. The embargo thereby demonstrated that resource concentration could offset traditional military and financial asymmetries. Structural origins of the oil weapon. The emergence of the oil weapon was rooted in decades of structural imbalance between resource owners and consuming industrial powers. Throughout the early and mid 20th century, multinational oil companies, often referred to as the Seven Sisters, maintained dominant control over extraction, pricing, and distribution networks. Oil producing countries received limited rent capture relative to the strategic importance of their resources. The formation of the Organization of Petroleum Exporting Countries (OPEC) in 1970 marked the beginning of a gradual reconfiguration of bargaining power. Over time, producing countries increased nationalization of oil assets and improved coordination over pricing strategies. By the early 1970s, the geopolitical climate created an opportunity to translate latent structural leverage into active strategic pressure. The Yom Kippur War of October 1973 provided the trigger event. Arab members of OPEC, coordinated through the Organization of Arab Petroleum Exporting Countries (OAPEC), imposed production cuts and selective embargoes against countries perceived as supporting Israel, most notably the United States and the Netherlands. Production cuts and the quantitative supply constraints. According to the intelligence summary presented in the document's early pages, Arab oil ministers announced a 25% reduction in production levels compared to September 1973 benchmarks. The report notes that the cumulative reduction of approximately 1.95 million barrels per day by mid-November represented a meaningful contradiction relative to global consumption levels. The embargo particularly targeted the United States and Netherlands, while other Western economies experienced partial reductions rather than full exclusion. The report highlights that supply shortages would not be immediately visible to the end of consumers due to existing inventories and transportation tax. However, structural deficits were projected to emerge within several weeks as stockpile diminished. Estimates indicated potential supply shortfalls of approximately 2.5 million barrels per day for the United States during the winter of 1973-74, representing roughly 30% of consumption requirements. These figures shown in the statistical table on page 7 illustrate the scale of dependence that structural economies had developed on importing petroleum. The intelligence assessment further indicates that Western Europe faced projected deficits of approximately 3 million barrels per day, equivalent to roughly 15% of consumption, while Japan risked losing roughly 9% of its oil supply. The quantitative projections demonstrated that the embargo's effectiveness derived not only from reduced output, but from structural import dependency accumulated over decades of industrial expansion. Differential enforcement among oil producers. The document reveals that not all producers implemented reductions with equal intensity. While Saudi Arabia and Kuwait adherent relatively close to announced production cuts, other states displayed variation in compliance. Libya, Iraq, Iran, and Algeria supported the embargo theoretically but faced technical or political constraints affecting implementation. Abu Dhabi enforced oil embargo measures against the United States and the Netherlands but didn't reduce production proportionally. Algeria encountered operational challenges in extraction fields. Iraq have not signed the Kuwait agreement, reduced production primarily due to pipeline issues rather than political coordination. These inconsistencies illustrate a central principle of cartel behavior. Collective action problems persist even when members are sharing strategic objectives. Divergent fiscal needs, technical capabilities, and political constraints limit political compliance. Nevertheless, even partial coordination proves sufficient to generate significant global price effects. United States vulnerability within apparent power. Despite being the world's largest industrial economy, the United States demonstrated substantial exposure to external energy shocks. The report estimated that domestic production of approximately 11.3 million barrels per day was insufficient to offset declining imports. The resulting supply gap required reliance on strategic reserve, stock downdraws, and conservation measures. The intelligence documents suggest that the United States could temporarily mitigate shortage by drawing down inventories accumulated by major oil companies. However, this approach merely redistributed scarcity across time rather than eliminating it. The report indicates that sustained shortage could emerge by mid-winter, particularly in heating oil markets, potentially affecting both industrial production and household consumption. The vulnerability illustrates a structural paradox. Economic scale doesn't guarantee resource security when supply chains depend on geographical pardon. The vulnerability illustrates a structural paradox. Economic scale doesn't guarantee resource security when supply chains depend on geographically concentrated commodities. The embargo therefore exposed a critical weakness in the post-war industrial growth model. Western Europe fragmented policy response. Western Europe exhibited significant heterogeneity in exposure to the embargo. The Netherlands faced particularly severe reductions due to its perceived political alignment with the United States. As noted in the discussion before, the Dutch government was compelled to consider restrictive measures, including reductions in automobile fuel consumption and industrial output adjustments. France and the United Kingdom attempted for diplomatic engagement with Arab producers to secure preferential treatment. France, in particular, sought to position itself as politically independent from the United States foreign policy, thereby improving supply prospects. These divergent diplomatic strategies demonstrate the fragmentation of Western policy responses under conditions of resource scarcity. The European community considered collective measures including shared stockpiles and coordinated consumption reductions. However, the intelligence assessments suggested that intra-European coordination remained incomplete, limiting the effectiveness of collective European response. Japan strategic adjustment under resource constraint. Japan represented one of the most vulnerable major economies due to the near total dependence on imported oil. The report estimates that Japan could lose approximately 500,000 million. The report estimates that Japan could lose approximately 500,000 barrels per day of supply, representing roughly 9% of its consumption. The statistical table clearly shows Japan maintains stockpiles equivalent to approximately 280 million barrels, providing short-term buffer capacity. Nevertheless, the document notes that sustained reductions could impose constraints on economic activity due to disruption challenges and structural dependence on imported energy. One of the most enduring institutional consequences of the embargo was the creation of strategic petroleum reserves designed to buffer future supply disruptions. Government recognized the market mechanism alone were insufficient to guarantee energy security under geopolitical uncertainty. The embargo also accelerated investment in alternative energy sources including nuclear power, coal, and later renewable energies. Although oil remained dominant, diversification reduced vulnerability to future supply shocks. The Arab oil embargo demonstrated that resource ownership can generate geopolitical leverage exceeding conventional military capabilities. Oil-producing states successfully altered global bargaining dynamics by exploiting asymmetries in dependencies. Resource nationalism emerged as a central feature of global political economy. Producing countries increasingly asserted control over extraction and pricing mechanisms, capturing greater shares of resource rents. Sovereign wealth funds emerged as instruments of managing resource revenues and stabilizing fiscal policy. The redistribution of resource rents contributed to the emergence of new financial centers and altered patterns of global capital flows. Petrodollar recycling became a defining feature of international finance during the late 20th century. The intelligence reports reflects an early recognition that energy markets constitute a strategic domain rather than pure economic terrain. The government's detailed projections of supply deficits across the United States, Western Europe, and Japan illustrate an effort to anticipate systematic vulnerability. The reports emphasize on stock drawdowns, transportation lags, and differential enforcements among producers demonstrates an understanding of complex system dynamics. Supply chains operate as networks subject to non-linear disruptions. Small percentage of reductions in supply can generate disproportionately large price movements when demand elasticity is low. Conclusion: the Arab oil embargo of 1973 marked a structural inflection point in the relationship between resource ownership and geopolitical power. The embargo demonstrated that control over critical commodities can alter global strategic equilibria without direct military confrontation. The episode exposed vulnerabilities embedded within industrial growth models dependent on concentrated resource input. It triggered institutional innovation, including strategic reserves, energy diversification strategies, and new approaches to macroeconomic policies. More importantly, the embargo illustrated that economic systems are inseparable from political power structures. Control over production nodes within global supply chains confers leverage capable of reshaping alliances, policies, and institutional frameworks. The legacy of the embargo persists in contemporary debates over energy security, resource nationalism, and geopolitical competition. In emerging domains such as rare earth minerals, semiconductor supply chains, and renewable energy infrastructure, energy remains power. Control over energy remains control over system behavior.